All right, Zach Lemaster, welcome to the REI Diamond Show. How you doing today?
Dan, I'm doing great. It's a pleasure to be here. Thank you for having me.
Yeah, for sure. It was very interesting. I saw the bookings come through. Turnkey rental property was a big topic a few years ago. So I've been in the business since 2006, and I remember those companies proliferating probably, right as things started to come out of the Great Recession. There was a lot of turnkey rental businesses in the Atlanta market. I knew of some in the Philadelphia market. And I've seen some come and some go. And I think some of them went like in the Atlanta market, you could get houses for 25, 30, 35, 40 grand. They were selling them for 75, 80, 90. Well, the prices kind of ratcheted out of that price point, and then you couldn't find the inventory, so that became like a big issue for those companies, and they kind of wound them down. And the investors were very happy because their investments went from 100K deals to 250 and 300 without renovations or any other additional costs. So we've seen them come and go, and you've been around for a while and you have an interesting model with the new construction. Do you want to kind of give the audience an overview of the business model here?
Yeah, I'd be happy to, Dan, and thanks for starting there because I think turnkey in general it's a buzzword, and like any business, but especially in real estate, there are companies and uh, different business models that work in certain market cycles and some that don't work in other market cycles. For as you just alluded to, I mean, it's great. That's the beautiful thing about investing in real estate is if you I don't want to say time the market, but if you invest over the long term, like your property should go up over time. And it sounds like during that market cycle that you just mentioned in your history, there's a lot of people that did really well. But turnkey investing, it's a buzzword. So there's a lot of people that, may have had experiences with turnkey in the past or don't really know what that means, or people saying turnkey could even be a broker saying a house for sale is turnkey, right? So it's really ill-defined. But what we try to define turnkey as is first we look at the markets where there's the best investing opportunity from a global picture, right? We're looking at the areas throughout the US that have affordability, that have high rental demand relative to home prices, where you can still have positive cash flow, areas that have diversity of industries and have economic and population growth. We want to be in the path of progress, areas that have landlord friendly legislation, low taxes. So, I mean, fundamentally, we want to be invested in areas where we know we're going to have a quality investment product over a long period of time. But essentially, what turnkey is we sell houses that are newly built because we mainly focus on new construction or fully renovated, leased, and professionally managed in an area that meets all of our criteria. So the idea is that an investor on the front end, regardless of your experience level, regardless of your um, where you're located physically, or if you don't want to necessarily be an active landlord or your local market's too expensive, whatever the case is, if you want to easily access deals across the country where everything is kind of handled for you, that's kind of the idea. So you can come in and buy real estate, diversify across these other areas, get started easily, where you have a team behind you that's going to guide you through how to successfully do that and handle everything for you. We mainly focus in two main geographic regions. This is the Midwest and the Southeast, where I know you're very active as well. The Southeast is a great area. We know that the population is really shifting down, right, down to the Sun Belt. And so those are areas where there's an undersupply of housing. And those are areas that we try to focus on. New construction house could be anywhere from $200,000 to $300,000. We try to be below the median house price point in the U.S., which is 400K. So we try to be below that. That way we have the largest pool of tenants and also retail buyers when it comes time to sell those houses. So I could probably talk all day about that, but that's a quick summary on what we view as a turnkey model.
Yeah, and I think, the long term of real estate, I didn't time the market with my rental properties. So, my own experience, uh, the rentals worked, there's mortgage pay down. My business continued to grow, and they've become a little bit more of a hassle than I like for the amount of investment gain that's occurring in the background. So, I'm actually in the process of selling off my rental portfolio, and I'm going to put that money into like an expensive vacation rental in a very constrained high end market that I consider to be bulletproof. So that I have one mortgage and one insurance negotiation per year, one property manager, and tenants who prepay and stay for a week, and then they're gone, and then it sits vacant for like 9 months. I kind of like that actually, just from a simplicity sake. So that's not really an ROI driven investment decision for me, but more of a simplifying the estate decision. That said, my methodology for selecting markets was, oh, I grew up in the Philadelphia market. Let me buy some of these Philadelphia houses where we happen to be doing our flips. A couple of them are in the right area. They went up in value. A couple of them probably went down a little bit. And I'm going to take a little bit of a haircut. And I'm like, I don't care. I just need to get out of them because I'm trying to simplify my life. So there was no market selection there other than that they were in my backyard. And I own some stuff for the same reason in the Chicago market. That's also, I'm signing contracts this week to divest myself of them. If I had it to do all over again, I mean, I started from broke, and I'm sure there's some people listening who are like, that's where I am. I need to get rich in real estate first. And I think there's probably a good case for the buy, run the rehab, rent it, do the refinance, and be an active investor to build up your war chest, as it were. But on the flip side of that, I think that, if I was in a position where I was already making some money, 100, 200 grand a year, maybe more than that, I would have approached this a whole hell of a lot more intelligently, which sounds like what you talked about. Let me look around the country and figure out what markets work for a little bit of cash flow, but probably more important than that, the diversity of the industry, the low taxes, and then the part that I really like about your model is it's new construction. So all my rentals, Zach, are early 1900s brick. We're leveling out the floors for the tenant at the cost of like $13,000, right? And one of them happened. That's not new construction. I get crushed on the repairs. My Chicago apartment buildings were built probably in the 20s or the 30s. And it's the same kind of thing. It's replacing all the electrical. It's um, plumbing issues and leaks that are kind of never ending. So the repair bills and all those repair conversations that I'm having as a busy professional to manage my rentals, it's unacceptable. And that's what's led to this simplification streak that I'm currently on. And I'm not opposed. I see the turnkey market and I'm like, probably wouldn't be too bad to have, say, 2, 3, 4, 5 new constructions. The cash flow maybe is okay. We're probably not talking home run cash flow when you go in and you do your renovation yourself and really focus in on it. But having 4 or 5 that were new construction in a portfolio, it feels like it might offer more of the simplicity that I'm going to get out of that vacation rental versus let me get to 30, 40, 50 units in my own backyard. And I don't want to be in the rental property business, which is kind of, even though I have a manager, it's kind of like what I'm doing if it's in my backyard, and most investors too. What would you tell me as far as how simplified and easy it is to own properties that your product is offering compared to sort of the old way of doing the business?
Yeah, so much to unpack there, Dan, and I agree with you 100%. And then we see this transition over time as people build large portfolios, and myself would be included in this. In the very beginning, I started investing 15 years ago. I was an Air Force captain and an optometrist, working at the Air Force, and just bought my first house hacked it. It was a duplex, moved out of that, kept it, bought more and more. And it's the same thing. I started locally because that's what I knew and felt comfortable with. The pivotal moment for me was where my wife and I identified that, hey, we can actually invest across the country, building a process around this where we can identify locations that are more conducive to our goals, that offer better returns, that have better upside. And when we were able to successfully do that, that's what allowed us to dramatically scale our portfolio and retire from our career path in medicine, is by being focused on the areas that have better returns. And so I just want to call that out first. Is a lot of people think that they have to start locally because that's what they know and feel comfortable with. And I would argue that, I mean, you certainly could, there's nothing wrong with that, but I would challenge them to think outside of the box to really evaluate, does this make the most sense? When you scale, and this is getting to your question, but when you continue to scale, like, it's a balancing act. Everyone's like, I got to own X amount of doors to have X amount of cash flow to be financially free or to get the net worth that I want. And everyone's working really hard to get to that number. And then once you get there or surpass that, it's like, man, I'm working more than I anticipated. This isn't as passive as I'd like it to be, right? And so it's like a wake up call. And I went through the same thing. There was a point in time where we had over 100 doors spread across multiple different markets. And it was just, I had managers for each one of those areas, right? But it was still like managing the property manager and herding cats and a lot of chaos. And so we went through some simplification ourselves as well, where, and this is a common path to follow, where we invest in single family residential or small multi as a good starting point. And I still believe that's the right place to start, is especially if you're intentional on the location. And then we trade up, right? You trade up and you consolidate, go through 1031 exchanges. Just like you mentioned, we own some high-end luxury short-term rentals out here in Colorado in the mountains where I'm at. And those things are on autopilot because we have a great managerial team and they produce excellent returns. We also have traded up to commercial multifamily and retail buildings where management handles everything from even making the mortgage and interest and payment and handling everything with the tenants, leasing. So, I mean, there's this consolidation and trade up because I don't think that you want to have 100% of your assets in, single 100 doors across multiple markets like we did at one point. But anyways, to tie this back to your question, how passive can this be? I think the first thing I'll tell you is there is no such thing as true passive income. Just understand that. You always need to be managing your money, right? And being conscious of your money. People like to think about passive income as investing and forgetting about it, but there are more passive ways to invest in real estate. We specifically chose new construction. We didn't always work in new construction. We did a lot of the renovation in the older homes, just as you alluded to, Dan. And I mean, that causes more headaches over time. So we chose new construction because it's new. You have a much more predictable return. You have better quality tenants. It attracts more tenants overall. So you end up having less vacancy, less turnover. People tend to stay longer. They take better care of the houses. They're just overall better tenants for more predictable returns. But most importantly, new construction, especially in growing areas where there's significant demand and undersupply of houses, we found over time that not only is the cash flow and returns more predictable, but you have better upside. You have better appreciation in home value, in rents. Our average rental increase is 6% per year. That's more
Wow.
than double the national average. That's because we're building specifically in areas where there's demand. So it's not only about, I mean, so I guess to tie this all back, investing in turnkey new construction, I think, is a much more strategic approach to consistently scale your portfolio where you're not having to, buy yourself another job, where management, all the teams and systems are already in place, and the property itself is going to be less of a headache than maybe an older property. And that's our goal, is to allow someone, regardless of where they live or their experience level, or, most of our clients are people that have W-2s or they're self-employed, whatever. They have capital. They like real estate. They don't want to be a property manager, right? And they don't want to manage they want to they're investing in real estate to have more time, not less time. So that's our approach to it and why we focus on new construction.
In the new construction, Zach, do you find that the average tenant lease length is longer, or has it not been running long enough to kind of get a comparison to, like, this was the existing renovated product, tenant stayed 2.4 years, new construction stays how many years?
Yeah, it's about a year longer on average. So we're close to about a 3-year occupancy time frame for new construction tenants, and we're about a year and a half to 2 years. So about half of that on, what I would call C-class assets that are older homes that are rehabbed.
Yeah, very, very challenging. The other thing about the new construction turnkey model, so like when I started, I, s- I still struggle with this. And it's this like internal need of cheapness, right? It's like we make our money because we're buying it low and we're putting our renovation in and we're selling it for a higher price. And so it's like I'm always looking for the price, and maybe sometimes I've missed the value, especially on the things that maybe I've held long terms. Oh, it's like it's cheap enough, I could buy it, the payment's low, it just looks manageable, it looks low risk, but yeah, it's also low return because we're dealing with lower rents and more challenging tenants and more renovation issues. And one of the things over the past few years was um, my attraction to mortgage paydown. And I think a lot of times we get into business, Zach, and we hear things like, well, it's all about the cash flow. Don't even count the mortgage paydown. It's all about getting to 10 or 20,000 or whatever your monthly number is so that you can quit your job. There's so much focus on that, at least from my viewpoint in the real estate education space. There's like a downplaying of, if you will, the mortgage paydown. But the thing over the past 4 or 5 years is I kind of like the more expensive assets because maybe I'm stretching to put my 20% down, and it's kind of thin and scary at the time when you buy something for, let's call it 500 grand, you put 100 grand down and you got like 150 in the bank, you put 100 down, it's like, man, that vacuumed your account. But now, two, three, $400, whatever you're making per month, maybe it's more than that in cash flow, but the mortgage pay down over time is paying off this $400,000 asset. So at the end of the day, without any appreciation, you bought the $500,000 asset and the rent's paid it off. It's worth 500 30 years out when you pay it off. Whereas if you bought a $100,000 asset and there was no appreciation, you got your rental and that was paid off the entire time, you had 100 still sitting there, right? So that's why I like the higher end vacation rental, because it's something with this, multi-million dollar mortgage that will pay for itself at the end of the day. And if no other appreciation occurs, it's collected itself a whole hell of a lot more, value in the equity. So I think maybe we could dive in as an example of that. Would you mind touching on one or two example new construction deals? What do the numbers look like on a new construction turnkey rental?
Yeah, that's so important, and I have a lot that I want to digest with and discuss. So you just mentioned, because that is so common for people when they're first starting in real estate to just be hyper focused on cash flow. But we know over time, you talk to any experienced investor that's built wealth, it's the other asset, it's the other ways that you earn income and build your wealth in real estate investing outside of the cash flow. It's almost like cash flow is like a byproduct, or people look at cash flow as a way to just support the investment. But all the other ways that you build wealth, we call real estate the ideal investment, which is an acronym for all the ways you build wealth. I is for income, that's your cash flow. Again, most newer investors just focus on that because it's tangible and they can't really fully understand or conceptualize the other areas. But D is depreciation and your tax benefits. And I would argue that, I don't know if you do things like cost segregation and accelerated depreciation, Dan, but like to me, that's the biggest impact immediately out of the gates, year one, right? Because on a $1 million house, you could potentially get a $300,000 tax deduction. So that's a 100% bonus depreciation, but that's a $300,000 tax write-off you get year one. That's money you would otherwise pay to Uncle Sam that you can actually reinvest and earn an income on. But to your point, there's other ways you build wealth. E is equity buildup, as a tenant pays a loan down for you. Real estate is a beautiful concept because you can borrow money from someone, i.e. the bank, to buy an asset that you have 100% of the benefit from, 100% of the ownership and control, that someone else is paying that loan off for you, right? And you just let that run its course over time. A is appreciation. All real estate goes up over time, regardless of short-term fluctuations. And then L is, leverage, using leverage. But a typical deal is, I would say, average new construction house, anywhere between $250,000 to $300,000. We'll take a Southwest Florida new construction house. That's probably a 4-bed, 2-bath, 2,000 square foot house. So bread and butter housing in an upper B or A class area. So these are areas where there's quality tenants. The rent is probably in the range of $2,400 to $2,600 a month on a $300,000 house. So you still will be positive cash flow if you're putting 20 to 25% down, even with current interest rates. And we're likely seeing rental increases at 5 to 6% year after year. And we're still seeing home appreciation in those areas because of a undersupply and over demand. Again, it's all about supply and demand, being in the areas where people are moving. But on that house, it should be very predictable. You don't have any maintenance the first year, because you have a builder warranty. You have structural warranty and mechanical for 5 to 10 years. So you don't have any capital expenditures. It's just very predictable. And one thing that we try to do, especially right now, Dan, is to be very creative with people to offer different buying opportunities, different financing and incentives that we have access to right now that we wouldn't have, a couple of years ago when the market was just a crazy seller's market. And so that's why right now is a really unique time to be able to make big moves. We have certain things where you can buy properties with as little as 5% down. True investment properties. This is from local credit unions. You can buy up to 5 investment properties. This is a portfolio loan. You can have builder incentives where you're getting upwards of 10% equity immediately on property. So on a $400,000 house, that's immediate $40,000 price reduction. You can also take that $40,000 as a managerial credit, where it's actually covering half of your down payment. You can use it to buy the rate down to as low as like a 3.99% on a 30-year fixed loan. That's going to skyrocket your cash flow and get way lower, almost half the rate that we're currently seeing today. So my point is that there's a lot of unique financing options and creative things that you can do in today's world because there's a little bit of excess inventory, because the market's slower, to allow you to make moves that you probably wouldn't otherwise be able to.
I mean, how can a 5% down loan work? You still have to cover the debt service, so wouldn't 95% kind of screw the economics of the deal?
Well, every property is specific, right? And most properties, if you have a 95% loan, yes, you're probably not positive cash flow, right? But we have many people that do that. That makes sense for them. That's maybe not. Here's an example. All right, we have a doctor couple that lives out in Seattle, and they're making $400,000 or $500,000 a year. Have newer investors. They have a extreme tax burden. They don't need cash flow because they make significant income through their W-2. They're looking for real estate as to diversify their portfolio as a long-term investment and a large ability to take tax breaks, right? So on something like that, or individuals like that, they put 5% down. You don't have to put 5% down. The point is here, you can put 6, 7, 9%. There's on this portfolio loan, there's no PMI and there's no prepayment penalty. All right.
Wow.
It's a 30-year fixed loan. It's a 30-year amortized loan in a 10-year term. Okay. So what this means is that in most cases, people's minds immediately go to conventional financing where they think I have to put 20% down. If I put less than 20% down, I have to live in the house and rent out part of it. And I'm paying mortgage insurance, right? Because I'm less than 20% down. So you got to understand the economics of the loan structure itself. But yes, in general, if you have 95% loan on the property, you're probably break even or negative cash flow. You could put a little bit more than 5% down to, structure that however you want to, but it depends on how it makes sense for your strategy. So like with this doctor couple in Seattle, they bought a couple properties with a 5% down. They had, let's say 100,000, or it was more than that. It was like a couple $100,000 to invest. And they could have bought with 20% down. They could have bought 3 properties with us at that $300,000 price point. Okay. But instead, and they would have got great tax benefits from those 3 properties. And I can go into this as deep as you want me to. They used him as a short-term rental for the first year. They took the accelerated depreciation. They got over $500,000 in tax deductions from buying this portfolio. But they thought, hey, I can expand this by using 5% down on 2 properties. Those 2 will be negative cash flow. And then I'm able to maintain the majority of my capital to buy 2 or 3 more properties that will be positive cash flow. And so as a portfolio, they're still positive, but as a whole, they're able to collectively buy more real estate with the same amount of capital and take immense amount of tax benefit. So it's things like that you just have to, and that's what we do with our investors, is work with them to structure the strategy. And you still have to qualify for this loan, right? You have to be financially, it's not like anyone can qualify for this. You have to have good DTI and, good credit and things like that to absorb that high debt. And also on one of those structures, we had a 10% kickback. So they basically, what they did is it was on a $300,000 house, they had $30,000 that they got back in their pocket. They put 5% down, $15,000. They actually got $15,000 back in their pocket, which they kept as reserves, right? So even though it was negative cash flow, like you got to map out the plan and the strategy. So that $15,000 is reserves to cover that. And, rents go up year after year. And what they will do is they will refinance that property within 2 to 3 years after they've built a little bit of equity in it. Once interest rates probably come down. So that's like the longer term plan. So again, I know I got way into the weeds here, but it all just depends on what makes sense for you.
No, I love it. The nuance and the detail is important. On that one, was that one done in the last 6 months to a year, that example?
Yeah, this was just recently. They just closed. Probably, I would say earlier. Well, it was about 6 months from now. So earlier this year.
So, what do you remember the projected maybe rent increase in that market? Maybe you could tell us what market that was, just kind of like for this couple to get comfortable with the negative cash flow is probably a lot easier if I know that I'm expecting rental increases at least one time in the next year.
Yeah. So again, average rent increases per year is 5 to 6%. That's not a theoretical number or speculative. That is track record number. So more often than not, we hit 6% year after year. Sometimes that's built into the lease as an escalation, right? If people are signing a 2 to 3 year lease. So they bought in multiple markets. These were all in the Southeast. They bought in Huntsville, Alabama, which is a growing market in Southeast. There's a lot of tech in government employment and growth in Huntsville. They bought in Tuscaloosa. That's a U of A. That's a really good market. And they bought in Florida outside of Orlando in what we call a town called Poinciana. It's in Polk County. It's about 30 to 40 miles southwest of Orlando. We would call that a secondary market that's adjacent to a large metropolitan area where, in Orlando, houses are 3 times the cost and rents are not 3 times the rents. But, it's being outside of those large metro areas, there's a lot of demand, a lot of growth. So all these areas are in the Southeast, new construction homes where, we were still seeing appreciation both in rents and home prices. But again, they didn't buy everything with this low down payment, right? We mapped out a plan together. The properties, some of them they did put 20% down on. Those are positive cash flow. Those are offsetting the negative cash flow ones. And so as a portfolio, it's very self-sustainable. But their main objective was a tax haven for that first year, right? And that saved them over 6 figures in actual dollars that they would otherwise give to Uncle Sam. Guess what? Now they can reinvest and buy other assets that have additional tax benefits, and they get the snowball. And more importantly, they have multiple properties where they're building well through all the things in the ideal kind of investment strategy that we talked about.
Yeah, and that circles back to, getting the larger mortgage. It's like, um, it's a big pain in the ass to buy a piece of property and to sell a piece of property. Probably, on the sell, it's got to go vacant. It's hard to get the tenants out. Now I'm carrying a vacant property. I got to do a turnover if I want to sell it retail. But on the buy, you have the mortgage application process. I'm hunting down the information on, this little nuanced piece of my tax return. I'm collecting property. It's a pain to get the mortgage. So to go through all of that one time and stretch and get $1.5 million worth in property with whatever it was, we'll call it $1.25 million in mortgage, give or take. But now you've set up that automatic payment plan or savings plan, right? It's like, to me, they're like IRAs in a sense. Like I set up this $1.5 million IRA, appreciation aside, but that $1.25 million mortgage, I just gotta like watch that thing go down over time. And I like look back, and from 15, 20 years in, I probably owe $650,000 on that mortgage. And I don't know that I otherwise would have allocated monthly to some account this pay down, right? So it's like, go through all that hassle up front once, get as much asset as your down payment can buy. To me, that makes sense.
Yeah, absolutely. And I mean, people need to pay attention to those things, right? An amortization scale on a loan, that's set. You know exactly how much principal you're going to be paying down at any point in time. So you can go through and calculate it out, right? And that has a physical return on investment associated with it. So yeah, you need to be conscious of those things. And especially buying higher end properties like you're doing, Dan. I know that you're, like most people, probably wanting to be conservative, but those houses will appreciate, and arguably nicer homes will appreciate better in those, higher end locations. So $1 million house appreciating 5% is going to yield your larger equity gain than $100,000 house appreciating 5%, right? But anyways, yeah, we share the same philosophy, I think, on that.
Yeah, and all of this is only possible. I mean, I got in the business in 2006. What year was it you got in? Was it
About 2011, I think, is when we bought that first duplex.
okay? Great timing there.
Well, yeah, it was okay. Again, I was stationed in the Air Force. I was a young captain. It was North Dakota. Okay cash flow market, not a great appreciation market. Some of those northern and midwestern states, even now, they don't have the downfall, but they also don't have the upside. So going back to my initial point, when my wife and I, allowing us to be focused on investing intentionally in different areas throughout the country, we saw better returns. I mean, that made a significant difference. But yeah.
Yeah, and all that is only possible. When I got in the business is when Zillow came out. I think it was '06. If I'm not mistaken, I think Zillow was launched '06. And I remember we're like sitting around the table in my office like, ZIL, what is this? L, weird.
Yeah.
And that's kind of the early like part of the electrification of our lives, right? We didn't even have the iPhones yet. There weren't podcasts. Um, but we didn't really have access to the information to select markets across the United States. And we're in this really unique time right now where we're still on the cutting edge of it. I mean, we're 2024, we're 20 years in, but like, how much harder will it be 20 years from now when much of this has been bought up already, I guess. We could see like a further compression of the cap rates, if you will, on these assets, and it could become, even harder to buy than they are right now, and that would equate to like higher prices. But all of this is possible because we have access to the information for these markets around the country. Like without that, none of this was possible.
Yeah, that's why companies like ours exist. But yeah, to your point, right now, I mean, we have an affordability crisis in the US. We have a huge housing shortage. The affordability crisis is the worst it's ever been. We have a deficit of 7.2 million houses in the US. And that what happens with builders, all the builders combined cannot build enough houses to meet the demand. But then you couple that with the institutions coming in and buying up the REITs and the Blackstones and all these institutional buyers that will buy up hundreds and thousands of, and they mainly focus on new construction, by the way, that build to rent properties. Those houses will never go on the market for the retail, for the average investor, for the retail market. We never see them, right? They get traded up into a fund, then private equity, and then they just keep getting retraded up and up. So they're never coming back on the market, and they disappear forever. And that's only hindering the aspect, right, or the issue we already have on affordability and access to inventory. So it's tough, but there's still good markets to be had. And again, if the institutional buyers are buying in these same areas, I mean, they do their due diligence, right? They have their entire team. They have entire teams of hundreds of people dedicated to identifying areas. So you don't have to overcomplicate it. Just do what they're doing.
Would you mind listing maybe your five favorite markets in order?
In order. Well, this is going to say like anything, Dan, this depends because I think that what is my favorite market may not be the most appropriate market for someone else, right? Different markets are better for different reasons, for different people based on your situation and your goals. And that's really important to understand. There's different price points, and it depends if you want to be really aggressive on the appreciation and growth side, if you want to be really cash flow heavy. So here's the areas that I really like, and we've already talked about a lot of them actually. And I mean, same reason I'm investing in these areas that this doctor couple in Seattle did. But so I like Southwest Florida. We do a lot of construction in Cape Coral, in Fort Myers, and Tampa. We like Central Florida, and this would be areas surrounding Orlando and those secondary markets. We do a lot in Ocala and like I said, Poinciana. I still like Texas, even though property taxes, are challenging, right around 2%. I like Houston and San Antonio. I think there's a lot of opportunity in those areas. And then the markets we already talked about in Alabama surrounding Huntsville. Huntsville has gotten a little crazy with competition, so it's hard to make deals pencil there. But you can again be 15 minutes outside of Huntsville and like Harvest, for example, a small town that nobody's heard of, but it's 20 minutes outside of Huntsville, and it's right adjacent to the country's largest arsenal for the army. So, I mean, there's little secondary markets like that can be really, really good. And we like college towns. We talked about Tuscaloosa. So those are some of our top areas. I don't know if that was necessarily in order, but those are the areas we're consistently building in and seeing, very predictable returns.
Do you think it would be helpful if we pick a deal that's actually available for sale right now and you and I talk through it as though I was going to buy that deal?
Let's do it. Let's go live. I love that idea.
And maybe so we'll do like you're doing my consultation here. You already know I hate my current rentals and I'm selling them. And I'm like lining up 1031 exchanges, and I have, on the low end maybe it's 280 to $300,000 purchase price with a gain of, well, the gain's probably only about 50 grand. If I had to guess, it might even be less. But that would be on the low end, and probably 1.1 million, 1.2 million on the high end. But the gains even still will be 400,000. I already talked about liking the higher mortgage paydown, and I like single deed scale. I like scale in the price of the property over scale in the number of markets and number of deeds and number of houses, right? I'm not a number of units driven kind of guy now. I kind of like the numbers to be bigger. So what do you have right now that might be interesting for us to talk about?
Let me just make sure, and we just had this conversation yesterday with a gentleman that was selling his house in California for like 1.5 million. It's crazy how real estate's appreciated in some of these coastal areas. It's an average house. Um, and he's going through a 1031 exchange and he's looking to like buy multiple because he can't even have with 50% equity in that property, he still can't be positive cash flow. And so he's looking to buy, multiple properties. But let me just understand, Dan, just to review. So what is the total spend? Because for a 1031, you have to buy the same amount that you sell. So what's
Yeah.
the total acquisition?
Um, for me, I don't know that I would put my full, let's call it $1 million in cash that's going to come back from multiple sales. I have options. Like I could do the 1031 from the small deal, that's the 150K gain, or it could be a deal where I'm at a $400,000, $500,000 gain. So
So
if I'm
just
not,
for the audience, let's use or even potentially theoretical numbers just so we can.
okay, I'm selling a three flat for 280,000. From that deal, I probably am going to have 150 to $160,000 in cash, but I have additional cash to put into this deal if possible. Because the more important thing for me is not making this one exchange for the other. It's largest property, largest mortgage. The 25% down payment is probably fine. I'm a little more on the conservative side if that's what makes the cash flow pencil out.
All right, so selling a property at 280, 150 in cash. And what is the gain on this? What did you buy it for? How much capital gains would you have on this?
It's not even a huge one. I mean, I'd be surprised if I had a $60,000 gain there.
Yeah, and that's probably past, in my opinion. I mean, this is the first thing to discuss is like, is a 1031 even worth it, right? Doesn't even make sense because of the costs associated. And I mean, we could down the whole rabbit hole of capital gains probably going up over time. But yeah, I would say at a $60,000 capital gain, like that would be worth it. The juice would be worth the squeeze to go through, to roll it into a 1031. So at $150,000 cash, you have to buy a 280 or greater. And it sounds like that, from what you just elaborated on with your goals, that the idea is to buy probably more real estate and own more. So again, you can let the loan be paid down. I would probably spend 20 to 30 minutes if this is an actual consultation to really hone in on exactly what your goals are. We want to know about what are important things to you. Do you want to be, again, more growth oriented? Is how simple do you want this to be? Do you want to stretch this capital as far as possible? Do you want to be hyper concentrated in one market? Are you open to looking at diversifying across a couple different markets? How important are tax benefits to you, right? And what level of cash flow or ROI are you looking at? So, those are some of the things that we would go through and try to understand for your 1031. But just on the surface, things that I think might be interesting for you. We have a couple properties that have pretty decent cash flow right now. Both of those properties, and these are in Prairie Grove, Arkansas. These are properties that are, 290, 288, $290,000. If we open up one of those brochures, I don't know if this is on video to do any screen share, but I can just run through the numbers. So like this is a brand new construction home. Can I screen share or is this just audio?
Do you want me to? I think.
Yeah. Yeah, you
Yeah.
can you can drive the ship. So if you go down to line 11 and 12, there's the inventory. You can see the brochure there.
Should I open that?
Yep. So here's a typical new construction deal. And let me just see. So when we're running our pro formas, we're always looking at it from a 30-year fixed loan. And as we were talking about before the show,
You want me to scroll down to the numbers here?
yeah, why don't you do that? Why don't you scroll down
Here,
there? And
here, a little further.
this is good if anyone can see this. So this kind of goes through and we have obviously the rental calculator on our website that you can go and plug and play because this is just a screenshot. And we also have our wealth tracker that you can see the link in below. That's a really unique tool that's just free for anyone to use. We had a software developer build that, and what it does is it allows you to track. We had them build it for us because we couldn't find a calculator that did this, but basically you can build a portfolio of homes or you can look at how your portfolio, and you can go through this real quick if you want. I mean, you can put in just fake stuff or whatever. You can still get access to it. It doesn't have to be a real email. Um, but basically what this does, Dan, is it allows you to track performance, not only individually for each property, but also as a portfolio. So this is one unique place, whether you're buying property with us or not, you can use this where you can look at how your properties are performing collectively as a portfolio. And most importantly, you can future project. So to your point, if you want to say, hey, I want to see where my equity position is going to be, even if I assume 0% appreciation, because you can put in whatever variables you want to, how much loan pay down am I going to have in 7 years if I have, 30 properties in here? And so you can actually go in and calculate these things out, and it will run, you can scroll it and run a projection on whatever scenario you want. But we built this out so you can not only track performance of an individual property, but also as a portfolio and future project. Really interesting tool. I'd encourage you to check it out, Dan.
And I would do that. I don't want to take 5 minutes setting it up and everything, just live on the call, but people can check this out. This would allow me to put in properties, whether I bought them with you guys or other ones around the country. I fill in my details, and it kind of gives me this ability to compare which may be performing better or worse. Is that
Yeah,
about accurate?
absolutely.
Okay,
Yep.
cool.
You can look at future properties you're potentially looking to evaluate. You can track your performance, on how the properties are performing. But most importantly, it allows you to look at a point in time in the future to kind of really, and this is the point here, is to really solidify in your mind of, okay, this is why I'm investing, right? If I want to have $1 million net worth in say 10 years and $10,000 a month passive income, like how am I going to get there? Right. And what do I need to buy every single year so you can reverse engineer that? Well, this will allow you to show you exactly, how to do that. But if we go back to the Prairie Grove property, like this would be like off the cuff without, for time purposes, without having a real detailed discussion with all of your goals. This would be maybe something that I would recommend as far as something to think about based on the price points. So, for you could probably buy, if you have $150,000 cash, you're probably looking at two of these properties, right? If you're putting 20% down, I think we run 25% on our pro forma, but you can put as little as 20% down. That would probably still save some money in reserves for you if you're doing a 1031 and you have to invest that. Or if you want to inject a little bit more capital, you could probably stretch this to a third property, or maybe use one of these unique loan options where you put 13% down instead of 20% or 25%. And still, in that scenario, you'd probably still be positive cash flow and stretch it to a third property. But those are all unique discussions we would have with you. But on this property, you can see that, we're factoring in all the anticipated things that we're looking at. So the rent on this one, the price is $292, rent's $2,200. You get a builder rent credit right out of the gates of $1,200. The HOA on this, I'm sorry, there is no HOA. Tax is $1,308. Insurance is $650.
$1,300.
It's all relative. Taxes are all relative. You look at some of the Illinois stuff you have,
Uh,
right? That's probably significant. I know because I used to invest
You'd
in
be yeah,
two
you'd be
flats.
10 grand, I think, for something that was new construction in anywhere in this market. And yeah, that's amazing.
So
That's
this is why we focus on the locations that we do, right? Taxes come into play and are important when factoring in your overall pro forma. By the way, I did own multiple two flats in Southside Chicago. I bought probably 10 years ago, and I did not I did not do well with those. They were probably D class locations and a lot of turnover dealing with CHA, Chicago Housing Authority. Anyways, factoring in a 3% vacancy. Now we don't have. We talked about this previously. We have 0% for management. You're anywhere from your first 1 to 3 years, you have 0% management. These are current. This is not always the case. This just happens to be an incentive that is being offered right now on this. So that helps the ROI factor. But over, say, if this was 2 or 3 years, you need to use the wealth tracker calculator to look at where you're going to be in 2 or 3 years. Also understanding rental increases and things like that. And new construction on a pro forma, pro forma is year one projected performance, by the way. Pro forma is year one projected estimated return. And so you really have to understand that. So if you're looking at year 2, 3, 4, that's where the wealth tracker can come in to help you calculate those out to see where you're at in 5 or 10 years based on expense increase, appreciation, rental increase. Taxes will also go up, right? Insurance might go up slightly over time. So it's really important to look at how this goes over time. But just on the surface, this would be something that I would say, this might be something interesting for you to look at, depending on, what other goals we discuss.
Yeah, and for anyone who's like listening in, we have a nice breakdown of everything, and we did mention a couple of the numbers from this chart, and you could find this right on the site. I do appreciate your presentation being so detailed for the inventory that you have. So we got to this point from a shared Google sheet that has the inventory and the selections available for anyone who's kind of like curious to check that out. One of the things I'm going to take a moment to elaborate on is the annual insurance premium of $656. It feels like it's low. However, as I'm doing the mental math of insurance in my head, I have a property in South Philadelphia. I'm selling it because the property next door went vacant, and I have all kinds of trouble trying to get property insurance on there. It probably should be $700-800 premium, and I think I'm paying like $2,200 because of this vacant property next door. And the older properties that I have with insurance get to be a big pain in the ass insuring every year. The insurers don't seem to like insuring the older vintage product that I own, built 80, 100 years ago. So I'm constantly getting like hit with inspection list of repairs, and they want me to fix these things, or maybe they're just doubling my rates so that I go take my business elsewhere. And I'm assuming that when I have a 2023, a 2024 built house, the insurance companies view those as a significantly lower risk product, and they're much more apt to continue to just renew those policies relatively light increases. Is that another advantage to go new construction, Zach?
Oh yeah, of course. And so for like this one, 656, that's a very specific number, right? That's because we have an actual quote. That's what you would expect. Now you can obviously add additional things and change your premium, change your deductible. That may vary that, but like we have an actual quote to support that. But you would do that. That's part of due diligence, right? Same thing with buying any property. You go through, have your appraisals, your inspections, you get your insurance quotes, you go through title work. Those are all things you finalize the number as you buy a property, like you buy any property. But to your point, Dan, yeah, I mean, look, we just went through this in Florida, and this is a big topic where it's like, insurance is going through the roof. People know that insurance is going crazy, but they probably don't know the details. Um, what's happening is it's the older homes, right? The new construction homes that are built to current standards are less risky to insurance providers. We don't build in flood zones. That's one thing where people really got hammered, especially in the Southeast, is being in flood zones. And floodplain maps are changing too. So that's something to be conscious of. But we like new construction because these are, in most cases, concrete block homes that are built to current standards that are required per building code, that are significantly less risk to an insurance company. So because of that, you don't see the variability that you do in insurance right now that we're seeing in a lot of, older homes. There's some people's premiums in areas of Florida that, went up like 300, 400%. And those are exactly that. The older homes that, in some of those, maybe they got rolled into a floodplain, maybe not. It's just the risk of insuring those for that geographic area went through the roof. But yeah, new construction certainly has more affordable insurance policies. And we always quote that and put that number on here.
So I'm going to highlight one number, and then I'm going to ask one question here on this example, and then we'll move on. Down payment 25%, $73,076, and then the cash flow, meaning after your mortgage payments, totals $7,342. So roughly 10% cash on cash before you have any rent increases that we are hoping for when we buy in Prairie Grove, Alabama, Arkansas, rather. The question I have is this product already finished and already rented when we go to settlement, or is this you buy it pre-construction, we get 1 month rent credit, but we might have actually 2 or 3 months of vacancy while we're waiting for our tenant?
All depends on the property specifically, but everything that we sell is already done. This house is done and ready to go. Some of them are already leased, some of them are not. This particular property is not, but the majority of our houses, especially Alabama, like all of our Alabama inventory, already leased. So you know exactly what the rent is. So it would be, you probably would, even though you have 1 month of rent credit, the average leasing time is like 26 days right now. So we anticipate that you won't have any vacancy, but there could be, right? So that's something you need to factor in. Right now we're in the summer months. It's a very active for leasing. If you're buying this house around the holidays in December, we would probably have the conversation with you to say, yeah, maybe have an extra, maybe leasing time is 45 days instead of 28 days or whatever. So, just being conscious of that. So, but you can see for anyone looking at the photos, like, this is a nice home. And it's, it's got some brick facade, and these are new construction houses in growing areas. So this is what we've kind of translated our business model into over time, because we used to do the same thing, Dan. We used to do the, 1900 rehab house. And, while you could potentially negotiate good deals with those, if you're buying distressed assets, there's just a lot more variability and headache over time, as, you alluded to in the beginning. So this is why we like build to rent.
Nice. All right, cool. What else did I forget before we hit our closing questions here? What else did I forget to ask that might be important for the listeners, Zach?
Gosh, so much, but I think we covered the general. I mean, for turnkey, if this is, if you're someone that is just new getting into real estate, and you're thinking, you want a little bit more hand holding, with a team that's going to support you. And I know that you do this as well, Dan, with your investors, but that's something we always help newer investors get started and help them scale. If you're someone that is a busy professional and doesn't want to be buying yourself with an active, an active job being a landlord, if you are someone that lives in an expensive market and your local real estate doesn't make sense, whatever the case is, turnkey might be an interesting way to, invest. It doesn't mean you need to buy all your properties this route, but it could be an interesting way to start building a presence in a new market and test the waters, see how it goes. So, yeah, can I give a plug on where people can find out about us, or?
Yeah, we'll do that in a moment. First, I'm going to ask book recommendations. Are there one or two recommendations you would make to people? Uh, I don't necessarily know that it has to be in the turnkey rental space, right? You started and thank you for your service with the Air Force, by the way.
Thank you.
I would say it's kind of a professional, and then you went into ophthalmology. What's that?
Optometry, yeah.
Am I saying that?
Yeah.
Optometry. Okay, so
Yep.
into optometry as a professional. So maybe book recommendations you would make to someone maybe in that kind of position who was thinking about being in real estate.
Yeah, I mean, obviously all the Kiyosaki stuff, I think that's, I think most people are aware, Rich Dad Poor Dad has changed so many people's lives. So if you haven't read that one, that's a must, of course. But I really like The Millionaire Real Estate Investor by Gary Keller. He's the founder of Keller Williams. Really talks about how the mindset, a lot of the stuff we talked about today, but in more detail about why are you investing in real estate from a math perspective, and how to buy a million, how to own a million, receive a million in passive income through real estate. I think it's just a really good book. And from a business owner standpoint, Michael Gerber has a good book, The E-Myth, or The E-Myth Revisited. That's a real good idea about thinking about growing, like approaching this like a business, right? Putting on the business hat, working on your business, not in your business, is really important for growth. So those are a few that really made an impact on me.
Nice. If you could go back and share the crown jewel of wisdom with yourself in 2011 when you were just getting started, knowing everything you know now, what would that be, Zach?
Everyone can say, I wish I got started earlier, or I wish I was more aggressive earlier on. I think we've built a very large portfolio and a successful business, and it's allowed my wife and I to live a lifestyle right now that we wouldn't otherwise. And we don't practice optometry. She's an optometrist as well. We met in school, but we have humanitarian efforts where we set up cataract surgery clinics in third world countries. And we're able to have a larger impact on people um, because of the financial position we're in, right? And so I think that's just really important. But I would actually go back and just give myself a little bit of words of encouragement, which would not change the course of anything, but would have made things easier throughout. Because look, real estate, like, this takes work, right? Even buying turnkey, even buying, like I said, there's no truly passive income. Now there's more passive ways to invest, but there's still people business. You're still dealing with tenants. This still is challenging, right? We've lost a lot of money on a lot of deals and bad partnerships and things like that. So I probably would have just went back and gave myself a pat on the back and said, it's going to be okay. And some of those down times, you're on the right course. You just got to stick to it. Um, I don't know if that's worth anything, but that's probably probably what I would have, that's what I would tell anyone right now, right? If you're in a tough spot investing in real estate and you're like, this, I just had a crap deal or I lost money. It's like, that's a short-term thing. That's a learning lesson. This is a lifelong journey. Consistency is what keeps people, or what makes people successful in this game is consistency.
That's right. I bet people needed to hear that right now who are listening, and it was perfect. So now is the time for the plug, Zach. Where should listeners go to get some more information?
Perfect. So we want to drive everyone to our website. That's rent2retirement.com, rent-to-retirement.com. We have our own podcast, our YouTube channel. We put out a ton of information about just market data and, different creative financing options like we talked about. Whether you're investing with us or not, we share a ton of resources. We're happy to have consultations with you, talk about your goals. If you're listening to this in the car, you can text REI to 33777. That's REI to 33777 to get on our email list, to set up a time with our team. And we're just happy to talk with people about investing. We're passionate about what we do.
Very cool. My final question is, what is the kindest thing anyone has ever done for you, Zach?
You told me this in the beginning, and I've been thinking about it. And there's a lot of different things that people have done that's been very kind for me. But I would say, kind of alluding to what I mentioned a while ago, I did have a mentor. I didn't initially, but I did have a mentor that, I was going through some challenging times. We lost a ton of money with a bad partnership, with a bad contractor, and I was ready to call it quits. And I had a mentor of mine, that is a very successful real estate investor, and he did give me some of that advice, and he told me, he said, Zach, I've lost a lot of money in real estate, but I've made more than I lost. And if you stay the course, that's gonna be how things turn out. So keep your chin up and stop making stupid decisions and partnering with people too soon before you, day before you marry them. So, anyways, I think just advice and encouragement is probably some of the kindest things that are less tangible than, say, money or whatever, but it's really important.
Very cool. Zach, I appreciate you coming on the show. I had a ton of notes. I had a great conversation. Really appreciate your time today.
It was a great time, Dan. Thanks so much for having me on.